Myself, R.P. Bhardwaj, convener of Trinagar Keshapuram CP Study Circle, welcome all the participants to today's seminar. Today we are going to discuss a very important topic, Companies Auditor Report, Order 2020 and amendments in Schedule 3. Speaker for today's session, CA NEHA Malhotra. She has already joined the seminar. I welcome our esteemed speaker to today's seminar. Before, I would like to our founder convener R.K. Gupta ji to kindly briefly introduce the speaker and start the program further. Gupta ji, it is over to you, sir.
Thank you, Bhardwaj ji. Very warm welcome, Neha Malhotra ji, in our study circle, and we welcome all the participants. To introduce the speaker, Neha Malhotra ji is a director in the audit and insurance practice of Deloitte India, and she has over 12 years of experience and is based in Gurugram. She has managed audits for various medium to large companies, including multinational and domestic companies, and her experience ranges across various industries, including services, trading, manufacturing, life sciences, publishing, and aviation. She is an associate member of both the Institute of Chartered Accountants of India and the Institute of Chartered Accountants in England and Wales. As we know, there are certain changes in the Schedule 3 and corresponding changes in companies auditors report order as well. So, members have been listening to various webinars and seminars on the topic, and we have also been sharing some of the material on this topic. So it is with a view to deliberate on this topic of amendments to Schedule 3 and Companies Auditors Report that we have invited CA Neha Malhotra ji to deliberate on the issue, and I hope her practical experience coupled with her knowledge will enrich the already exposure of our members. CA Neha Malhotra ji, please.
Thank you, sir. Thank you, Mr. Gupta, and thank you, Mr. Bhardwaj. Welcome to all the practitioners in the community. So today, as he's already mentioned, we'll be covering the Companies Auditors Report 2020 and the amendments to Schedule 3. So primarily the idea of bringing the CARO 2020 changes was basically companies, the regulation actually wanted the auditors to understand what the reporting requirements are to bring in more transparency and accountability, and hence these changes. And all these changes have also been cascaded to the Schedule 3 as well. So moving ahead, this slide talks about the introduction to CARO 2020, which is applicable from financial year April 1, 2021. It also applies to standalone financial statements except for the clause 21, which applies to the consolidated financial statements and not to the standalone financial statements. It also has the concept of materiality, and the period which we are going to consider is the whole accounting year for the reporting purpose. It's also applicable for the reporting of the components when we do a group audit. As far as the amendments to Schedule 3 is concerned, this is also effective from April 1, 2021, and the period which we use for reporting interim
Just a
period
minute,
also.
Bhardwaj ji, आप please mute कर दीजिए जो भी participants they are cross talking. So there is a lot of disturbance. I would request all the participants to please mute themselves so that we can listen to the speaker. Please. Please continue, madam.
Thank you, sir. The Schedule 3 amendments are applicable to all the divisions of the Companies Acts, that's Division 1, Division 2, as well as Division 3. The guidance note on CARO issued by the Institute of Chartered Accountants of India lays great emphasis on the word evidence and how they've defined the evidence, which is of very much relevance to the auditors who are also signing the financial statements. That's the opinion which is expressed is made on the examination of the records. The auditor should have sought and obtained all the information and explanations which are necessary. Due cognizance should also be given to the information and explanations given by the company and also the evidences which we have obtained from the company. They both have to be in sync with each other. Also, we cannot merely rely on the information explanation provided, but also they should be subject to certain reasonable tests to verify the accuracy and the completeness of the information provided by the management. So all these actually culminate into evidences, and thereafter we need to evaluate if there are any modifications in the financial statements or the internal financial controls which could have a repercussion on the CARO reporting. Audit documentation, which is again a very important piece for the auditors, and even the guidance note lays emphasis on it. The guidance note clearly stipulates as to what all would be included in the word audit documentation when it comes to the CARO. So they say that there could be a questionnaire which is submitted to the company. There could be specific inquiries which the auditor can make of the company, and also the management to understand how they are approaching all the clauses, what all documentation they have to corroborate with the various CARO 21 clauses. We can obtain replies in writing from the company which are signed by a responsible officer of the company who takes the onus and responsibility. These discussions then can be had with the management, the board of directors and the audit committee, and the checklist could have been prepared by the management and then it can be discussed with us. So all these pieces of audit documentation should be a part of the audit file which the auditors are supposed to maintain as per the standard on auditing, have a proper audit documentation around it so that it actually, the observer and the reviewer can also see that yes, what we are deriving, the conclusion which we are reporting in the CARO report, it resonates with that. These 2-3 slides which now I'm presenting actually gives a bird eye view. Here it talks about all the CARO clauses. Then we have certain circles which are in different colors. Like something like red, it denotes that yes, it's a red flag, probably relating to something which could be fraudulent in the company. Something which is gray in color could be something of the propriety in nature. Then these color codings in the background, the gray, the green and the blues. What I've done in this presentation is just to tell which clauses are modified clauses, which clauses are totally new to CARO 2020, and which are the clauses where there's no change from the earlier CARO. Against this, I have mapped what are the Schedule 3 changes to just give a holistic view as to what all changes in CARO lead to a change in Schedule 3 and then a disclosure in the financial statements. So against 21 clauses, we have, if I were to add all the sub clauses, the total count is 45. And if I were to see the split of those 45 clauses, sub clauses, there are 10 clauses where there's no change. There are 12 clauses where there's a modification. And then there are 25 sub clauses which are new. Okay. The green ones indicate the internal controls nature, grays in propriety, the red and red flags. The blue ones are primary performance indicators, something wherein the auditor is asked to comment on the ratios which one has to give, or probably the cash losses which has been incurred by the company. The yellow ones are with respect to the compliances with respect to the Companies Act. This slide talks about what are the amendments in Schedule 3, again, which has been categorized into 3 different buckets. The first one being what are the additional disclosures which are required in the financial statements and have been actually carved out from CARO 2020. There are other disclosures which I have highlighted in sky blue and dark blue on the subsequent slides, which talk about the other key disclosures and the other reporting requirements in financial statements. So if I were to first deal as to just giving a brief summary as to what all changes in CARO are leading to a divisional changes in the financial statements. Division 1, Division 2 and Division 3, 1 being the accounting standards, 2 being the Indian accounting standards and 3 being the NBFC companies. So the title deeds of immovable property, all the financial statements have to disclose the details if they're not in the name of the company. If there's a revaluation which is of 10% or more in aggregate, also has to be disclosed by all the financial statements. If there are any proceedings over the Benami property, again it has to be done for all. The borrowings on the basis of security of current assets, the quarterly returns which are submitted, if they are in agreement with the books of accounts or not, also has to be disclosed. The loans and advances in the nature of loans which are granted to either promoters, directors or the key managerial personnel also has to be disclosed. The utilization of the borrowings for the purpose other than which it was taken. Okay, if it is, there's a specific purpose for which the borrowing was taken, but if it is not really utilized for the specific purpose for which it was taken, then yes, it has to be disclosed accordingly. If the company is a willful defaulter, the details of such defaults, the ratios which have been stipulated in the guidance note which has to be disclosed by the management of the company. If there's a change or the variation is more than 25%, it has to be explained, or if there's any undisclosed income. So all these changes which are represented here in column 1 are the ones which were there in CARO 2020, and the equal and corresponding disclosure has to come in the financial statements. It's given in Schedule 3 of the Companies Act for all the three divisions. Few other disclosures, something like a prior period error, which is only applicable for probably Ind AS financial statements, where the effect has to be disclosed and it has to be restated. The shareholding of promoters has to be disclosed for all financial statements. The aging for trade payables has to be shown, and also for the trade receivables. One question which might come is the aging, should it be computed from the due date of the payment or the transaction date? The guidance note is flexible and it allows the auditor or the management to disclose what they deem is correct and what all information they can get or extract from the accounting package which the management is using. Apart from that, the aging schedule for capital work in progress, intangibles under development also has to be given. And apart from the aging from CWIP and intangible assets, we're also supposed to disclose in what all cases is the completion overdue or it has actually exceeded the cost compared to the original budgeted cost. And if there are any projects which have been suspended, it also has to be disclosed. The fair valuation of investment property has to be disclosed, and also if it was done by a registered valuer. Relationship with stock of company especially has to be disclosed. If there's any transaction with the stock of company, the management is supposed to bring that out and highlight it. Even as auditors also, we are supposed to comment on it. If there's any delay in the registration of charges or satisfaction with register of companies, it also has to be disclosed.
The Europeans are buying into Indians. Or maybe this is possible that.
Then we also have to disclose the compliance with the number of layers of the companies. There's a specific layer of companies which is allowed by the Companies Act. So the company has to comply with the rules and regulations of the Act. If there's approved scheme of arrangement in accordance with the scheme and accounting standards, one has to comply and document all of this. About details of funds guarantees taken from intermediaries for onward submission to the ultimate beneficiaries, where the transactions are floating from one party to the other and there are probably 2-3 parties involved, then how the funds have been going and what would be the repayment cycle. Everything has to be disclosed. If there's any detail of trading or investment in cryptocurrency or virtual currency, it has to be disclosed. There's a mandatory rounding of amounts in the financial statements. It was already there in Division 2 and Division 3, but now for Division 1 also the rounding off has to be done. The rounding off actually would be dependent on the income of the company, and one can refer to the guidance note on Schedule 3, which is issued by the Institute of Chartered Accountants of India. Apart from that, the details of corporate social responsibility activities also has to be disclosed, and because there's a similar reporting requirement in CARO. With regards to the regrouping in the financial statements, it's more with respect to the long-term debt. The current maturities of long-term debt, instead of other current liabilities, it will move to short-term borrowings. The long-term debt, current maturities in case of Division 2 financial statements from other financial liabilities to borrowings. Security deposit in case of the accounting standard financial statements from long-term loans and advances, it will be shifted to other non-current assets and to other financial assets in case of Division 2 financial statements. Then revenue from operations, there's insertion of grants or donations also. And for financial liabilities, the lease liabilities also will be disclosed specifically under financial liabilities. Apart from that, property, plant and equipment word has been given instead of the tangible assets, and underneath that one is supposed to disclose the intangible assets also. Turnover would be named as total income. So these are broadly the disclosure requirement changes, again, which are coming from the guidance note, and one can leverage the guidance note for the format of the financial statements. Moving ahead, broadly, I'll just tell you how the structure of the presentation would be. So what I've done is for all the 21 clauses of CARO, this left portion would be what the CARO clause says. Then these 3 buckets, 1, 2 and 3 specifically have been extracted from the guidance note to explain what the guidance note wants the auditor to do, what is expected out of auditor, to state that yes, these are the internal control elements existing within the company which the auditor should be aware of. Second, what are the audit procedures which one has to carry? And third is the points to ponder, which the guidance note says that there are few points of consideration which one might really think of while working on the CARO clauses and what could be the reporting requirements. Apart from this, I've tried to actually populate the Schedule 3 changes and assign it to each and every clause in terms of what all reporting requirements would be triggered in Schedule 3 as compared to what I am supposed to give in the CARO audit report. So moving ahead, this thing with this framework, and this is how the entire presentation would be in terms of all the 21 clauses. I'll just move ahead. So the very first clause is with respect to property,
Bhardwaj ji,
plant
please
and
mute all the participants because there is disturbance. So please mute all the participants.
yeah, I'll proceed. So the very first clause is with respect to property, plant and equipment. And underneath that also there are two clauses. The one which refers to property, plant and equipment, and the other one specifically for the intangible assets. Now one would argue, what would property, plant and equipment include? It includes the right of use assets, the investment property, non-current assets held for sale, and also the capital work in progress. So while testing the internal controls, one should be aware that yes, the PPE register, the property, plant and equipment register, which is obtained from the management, it has to be complete in all aspects. It has to be accurate, and also there have to be certain security around it in terms of who is going to alter the property, plant, equipment register. So there has to be a proper mechanism wherein if one person is making any change to the audit documentation or the register, it has to be appropriately reviewed by somebody else in the management. So segregation of duties is actually the key while maintaining the property, plant and equipment register. Also, if there's any movement of the assets and if who's the custodian of those assets, that has to be clearly brought in the register. Audit procedures, the register has to reconcile with the books of account, and also all the elements which are enunciated in the ICI guidance note in terms of what all should be included in a property, plant, equipment register, like location, the asset code, the asset description, etc. All of those elements have to be there in the records which are maintained by the management. As an auditor, one should not merely check for the full PPE register, but also the existence of the assets. The assets which are mentioned there in the register, do they really exist or not, is something which the auditor has to check. The reporting implications for Schedule 3, one would be to have a bucket-wise aging schedule for CWIP for both the projects in progress and projects temporarily suspended. The total of the CWIP would be equal to the CWIP which is disclosed in the financial statements, in the balance sheet in fact. For CWIP where the completion is overdue or has exceeded its original cost, the completion schedule including the expected period of completion has to be given. Here in few places I've given reference to the other CARO clauses because many elements of the CARO clauses have to be read in conjunction with the other CARO clauses. The sub-bullet here which I was referring to were the intangible assets. It includes the intangible assets only when capitalized and also the intangible assets under development. As part of internal controls, one has to check the completeness, the accuracy, ensure that yes, whatever changes the management is making in the PPE register, it's all approved and duly verified. The assumptions and estimates supporting the recognition of intangible assets is also important. That has to be seen. As part of the audit procedures, the auditor has to ensure that yes, the reconciliation with the general ledger or the trial balance is there. Also, what all should be the elements of a register which is given in the guidance note, all has to be prepared by the management. The appropriateness of the management's judgments supporting the recognition of the self-generated asset, the cost capitalized, also has to be seen. In terms of the considerations which the auditor should be thinking about, is that the mere reconciliation of the amounts reported in register is not the idea, but ensuring that yes, whatever is getting reported is appropriate, it actually exists. There has to be no differentiation between cost eligible for capitalization and abnormal expense or losses. The management's judgments and key estimates contradict with the other internal or external information. So one has to be cognizant. It cannot be different, but it has to be aligned. In terms of the Schedule 3 requirements, with respect to this particular clause, the bucket-wise aging schedule for intangible assets also has to be given, which gives details of both the projects in progress and the ones which are temporarily suspended. For intangible assets under development where it's overdue or it has exceeded the cost, the details and the completion schedule has to be given. Also, the relationship with stock of companies. Sometimes what happens is we've taken an asset, but the payment to the vendor has not been made. It stands as a liability in the books of account. So that liability is nothing but a transaction which is sitting in my books. And in case that liability is to a company which is now under the stock of definition of the Companies Act, it has to be disclosed separately. Clause 3, 1b talks about whether the property, plant, equipment have been physically verified at reasonable intervals by the management, whether there are material discrepancies, and if so, whether the same have been properly dealt. So again, 4 things: whether it has been verified by management, is the interval reasonable enough, whether there were discrepancies, if any, which were noted, and how were those discrepancies dealt with. So in terms of the internal controls, where are those assets located? The location of the assets one can verify. Whether the written instructions were issued by the management to across locations saying that XYZ personnel is responsible to carry out the verification. Then who are the competent employees who can actually carry out the verification? This is not a task which can be given to everyone, right? Then segregation of duties. Then the aspects covered during the verification would also, one has to see if it's in the condition and the usability of the asset. So for example, if there's a plant and equipment which is sitting in the plant location, in the manufacturing location, probably maybe somebody in the admin team would not be able to really understand if the machine is working or not. So it's very important that the management identifies who is supposed to do the verification, and we as auditors then rely on the physical verification report provided by the management. Then what are the actions taken by the management in case they identify a discrepancy? And the management needs to understand the rationale of a discrepancy, because if there's a discrepancy, it means the controls were not adequate enough to really opine on it. In terms of the audit procedure which the auditor has to carry, one is the evaluation of the reasonableness of the method, the intervals, whether considering the size and nature of the business, the time gap during which the management does the verification, does it gel up, is it in sync with that or not? Then the inquiries with the personnel who were involved in verification, so that we can understand whether it was done in spirit or it was just a tick in the box approach which is carried by the management. The reconciliation of the assets verified with the assets recorded and vice versa. Also, what are the actions which have been taken by the management to avoid these discrepancies. Points to ponder, which are generally for auditors to think, that physical verification not covering the underlying assets of CWIP, investment property, right of use assets, non-current assets held for sale. What if these are not covered? So one needs to apply that judgment, ensure that yes, they get covered, or what could be the reporting implications. Then keeping a copy of the verification report provided by the management without actually reconciling it with the assets which are recorded in the books of account, which should not be the case. And if there are any actions which have not been taken by the management, but management is very well aware that there were discrepancies, then how did that get reported? So all these requirements, all these considerations, one has to really take into consideration, has to be cognizant of while actually reporting the clauses which are there in the CARO. Clause 31C, which talks about whether the title deeds of all immovable properties, other than the ones where there's a duly executed lease agreement with where the company is the lessee, should be disclosed in the financial statements and are held in the name of the company, and if not, provide the details. So it says that yes, one has to note who has the security or the custody of the title deeds, the validity or the legal determination of the title deeds, then identification of cases where property titles are under dispute. And yes, all of this has to be tested. In terms of audit procedures, one needs to inspect the original title deeds, take the confirmations from lenders in case the title deeds are pledged, verify the accuracy of the details like the date of purchase, the underlying land measurement, the purchase cost, etc., to see the authenticity of the title deed. Then also corroborating this information from the online records. At many times there are various sites wherein we can just go and check whether that's true or not. So we have that facility. One can do Google, use the Google functionality and do that. Verify the lease agreements forming part of right of use assets to confirm whether they are duly executed in favor of the company where the company is lessee. Continuing clause 31C, the points to ponder is, at times what happens is one just verifies the scanned copies instead of the original title deeds, which could be a document which could be fraudulent. Nobody knows, right? So it's better always to ensure that yes, all these immovable properties are original, the deeds are original ones, and one verifies it from their eyes. Then sometimes lease agreements not duly executed but not reported in CARO. At times it so happens, so one should be really cognizant of doing that. Then disclosure of title deeds which are pledged under the terms of borrowing, but inability to verify original documents not reported. At times we just assume that yes, we've got the scanned document, the original would be very much similar, but we don't really know, right? So it's always better to see the original document and then ensure it's there. At times, even when we buy a building, there has to be a proper NOC. Basis that NOC approval and permits that yes, the title would be passed on to the person who is buying it. In case of disputes, At times we don't obtain the legal opinion, which one should. In case of name change of entity in merger, title deed is not updated, but somehow it just doesn't get reported in CARO. So all these are points which one has to
Neha ji, here
consider.
is a question.
Yes, sir.
Suppose the title deeds are with the banker.
Right.
Company has pledged the documents to the bank. Then how to verify whether to obtain certificate from the bank or how to verify in such a scenario?
Yes, sir. So my views, honestly speaking, it would be just personal to what I believe. My understanding
Yes.
is that yes, certificate from the bankers need to be taken, and if we can go, the bankers authorize us, then yes, we can verify it also. But certification from the bank would be very much needed because it's just like a confirmation, obtaining external confirmation.
Okay, okay. But suppose banker says that deeds are lying at the head office or at some other place, then
Then that fact has to
it,
be reported in CARO. A factual statement should be made.
okay, okay, okay. Thank you.
Yeah.
Please continue.
In terms of additional regulatory information, the question is what all should be disclosed. One is details of all the immovable properties where the title deeds are not in the name of the company. It should be in the prescribed format to the possible which we can obtain in terms of the description, the gross carrying value, the title deeds. If they are not in the name of the company, who are they in the name of? Is they in the name of the promoter? And what is the reason of not being held in the name of the company, or if there's any dispute, etc. Then registration of charges or satisfaction yet to be registered with ROC beyond statutory period. The details and reasons also have to be disclosed. Clause 31D, which talks about the revaluation of property, plant and equipment, stating that if there's a revaluation, whether it is based on the valuation by a registered valuer and they are specifying the amount of change, and if it is 10% or more in aggregate, it has to be disclosed. So as part of the internal control framework, one needs to evaluate the independence and the competence of the registered valuer who has done it. The revaluation should be of the entire class of assets, not just one asset we are going to cover. And also if it's appropriateness, measurement and disclosure in the financial reporting. As part of audit procedures, evaluate the validity of the membership license. Registration should be with the IBBI. The review valuation report for compliance with the valuation standards. Determine the competency of the valuer. Understand and evaluate methods and significant assumptions used for the estimating values. So this, whatever internal controls and audit procedures is laid down in the guidance note, it actually is emanating from the use of kind of these specialists. So there's a standard on auditing which talks about when these specialists are used, what all audit procedures the auditor has to carry out to ensure that the work which they are getting leveraged from these specialists is also, because ultimately the auditor is signing, right? The auditor has to own up what is getting signed. So all of that has to come.
Neha ji, CA
Yes, sir.
Nitish Chuk ji is with us. He is a registered valuer. So Nitish ji, would you like to add something? Nitish ji, you are not audible actually.
It seems there is some problem, technical problem with his voice. जैसे ही वो अनम्यूट करते हैं तो ये जैसे आवाज आती है जैसे पानी गिर रहा है
हाँ
कहीं से इस तरह की।
हाँ, कोई ऐसा लग रहा है जैसे कुकर चल रहा है कोई घर में। हाँ, कोई बात नहीं, नेहा जी प्लीज कंटिन्यू प्लीज। हाँ जी।
जी। The points to ponder is not retaining a copy of the valuation report, which is being carried out by the registered valuer. Probably not performing or documenting the procedures required by standard on auditing 500, which talks about audit evidence with regard to using the work of management expert, or probably at times not having discussions with the registered valuer. So what they're saying actually is that once we get the report, we should actually engage into a dialogue or a conversation with the valuer to understand their perspective also. In terms of revised Schedule 3, the reporting requirements, wherever the change in revaluation is greater than or equal to 10% in the aggregate of net carrying value of property, plant and equipment and intangible assets has to be disclosed. Apart from that, in terms of the additional regulatory information which is to be given under Schedule 3, one has to disclose whether the revaluation is based on a registered valuer only, which is defined under the Rule 2 of the Companies Act. Clause 31E, which talks about the Benami property transactions. It's very new, a kind of a red flag thing, because if it is there which is not reported in the books of account, auditor has to consider what are the steps one has to take to ensure that yes, it gets recorded in the books of account. So internal controls track any Benami proceeding on its status if there's anything which is going on. What is the appropriateness of the disclosure of the same in terms of the nature of the property, the carrying value of the property, what is the status of the proceedings, if there's any impact on the financial statements, and what if that liability is not recognized? Is there a specific reason for not recording it? All has to be considered as part of the controls. In terms of audit procedures, auditors can inquire with the legal team, the secretarial team of the management, the audit committee, to understand if there are any Benami proceedings which are going on. Focus on the ledger, on the legal professional expenses in P&L to understand what is the nature of the professional expenses which the company is incurring. If there's any proceeding, then one has to comply with the requirements of SA 250, which talks about the compliance of laws and regulations by the auditors, analyze the impact of it, inspect all the correspondences which the management would have, and also if there are proceedings which are deemed to be initiated, even if the show cause notice has been issued, it would be said that yes, it has been initiated, and then using the judgment one can report on this clause. In terms of points to ponder, at times what happens, there's no evidence of inquiry. So whatever we are talking, or probably whatever we are doing as an auditor, going strictly by the standard on the audit documentation, one has to document what has been done. Not extending the procedures till the date of audit report, one has to extend it, because if you're signing on a particular date, my opinion, which also talks about the subsequent events, that also has to be duly taken care of. Then additional regulatory information, which comprises of the details of the property, the details of the beneficiaries, what is the property in books, property not in books, and the nature of proceedings and the status of the same. This slide I've just broadly mentioned about what a Benami property means, which is actually taken from the Benami Property Transactions Act 1988, and it's actually, this snippet is given in the guidance note for just understanding what do we really mean by Benami property. So as an example, it says if there's a property which is carried out or made in a fictitious name, or where the owner of the property is not aware or denies knowledge of such ownership. So in this, the proceedings are actually initiated or expected to be initiated to ensure proper disclosure in financial statements. And one also needs to consider, would it really trigger reporting under 143.12, which is reporting on the fraud. And this is the Companies Act section on the fraud reporting. Moving ahead with the clause 2 on inventory. The first clause talks about whether physical verification of inventory has been conducted, again at reasonable intervals, and whether in the opinion of auditor the coverage was adequate and appropriate. The discrepancy of more than 10% or 10% or more than that for each class of inventory items has to be seen. So in terms of the internal controls, the coverage would include locations, extent, periodicity. It would also include who verified, who reviewed, all of that, whether there was timely action which was taken on the discrepancies. Also evaluate management's assessment of why of the discrepancies, as to why did it really happen, what if it has a spiraling impact on the other reporting obligations of the auditor also. For the audit procedures, evaluate and conclude PV of the inventories. Is it reasonable considering the size and nature of the business? Is it appropriate? What are the samples which the management took? In the opinion of auditors, how is it? Because I need to report whether it's done appropriately or not. Further, cutoff procedures also have to be done. If the verification is done prior or post year end, then the roll backward or roll forward procedures as stipulated in the standards on auditing with respect to the verification also, reconciling the count sheets, evaluating the appropriate actions taken on discrepancies. Points to ponder, at times one does not really evaluate and maintains in the audit file. So all these should be done. The written instructions which are sent to staff should be there in the audit file. The verification sheet should be there. Consolidation sheet should be there. There has to be a memo prepared by the management saying that yes, this verification was done and this is how we are going to disclose it. These are the discrepancies, how were they evaluated. All of that sequence has to be a part of the audit documentation, because whatever we are opining, it has to be backed by documentation, right? Clause 3.2b, again talking about the inventory, which says that if there's a sanctioned working capital limit in excess of 5 crores in aggregate from banks or financial institutions on the basis of security of current assets, whether the quarterly statements are filed are in agreement with the books of account. It does not really say that the quarterly statements should be audited. It just says that yes, it has to be in agreement with the books of account. And in case it does not, there has to be a proper reconciliation, which says that yes, if X amount has been submitted to the bank, the books actually contain Y amount, then some kind of a reco between X and Y. So the internal controls, there should be a timely booking of the GL entries to ensure what is going to be submitted in the bank at a particular date reconciles with what is there in the books of account. Again, documentation has to be there with the management, then only they can share with us. So sensitize the management on that. If there are numerous locations, compiling information for submission and its review. If there are numerous facilities also, then a tracker can be maintained by management. Again, a reconciliation in case there are differences. For the audit procedures, one can examine the sanction limit because it says it's the sanctioned working capital limit granted to the company. So the minutes of board of meeting would talk about these sanction amounts. If it is in excess of 5 crores or not, one can verify from there. Also confirm from the acknowledged copy of the quarterly returns, because whenever we submit anything to bank, they duly stamp it, right? So we can use that as an evidence. Then confirmation from lenders in the absence of any acknowledged copy where details are submitted. So ideally, we can probably write to bank that yes, this is what they submitted. Is it okay or not? And they can confirm, which is a good evidence, in fact. Then if there's any discrepancy, we need to consider what is the reporting implication of those the discrepancies. At times, the 5 crore computation is done incorrectly. So one has to really understand what it would entail. Verifying the returns submitted to the parties, one has to see what all details have been submitted. And in terms of revised schedule 3, two disclosures which actually go in sync with this working capital sanction limit is where the company has not used the borrowings from the bank for the purpose it was supposed to be. So if it's a working capital loan, it has to be used for working capital. There's no other purpose it can be used for. And therefore, the CARO guidance note also says that in case if there's the purpose for which one item has been taken, if it is a loan or in fact the funds have been taken, if it's not used for that purpose, it has to be specifically called out or disclosed. So again, this requirement gets triggered in all the clauses which actually have an element of a working capital limit or a loan, anything of that sort. And in terms of additional information, the company is required to disclose whether the quarterly returns are in agreement with the books of account, and if not, the reconciliation. So anything which gets triggered in CARO clause also has to be given as an additional information in the financial statements. This actually talks about what is the definition of a financial institution under the Reserve Bank of India Act. So they're in the process of financing, lending, acquisition, etc. So this is just something which I've taken from the guidance note as exactly the replica of what is given there. Clause 3, which is quite a humongous clause because it again has 6 sub-clauses within it, which actually talks about loans, advances in nature of loans, guarantees, securities, investments. So to who all would these 6 clauses be applicable, and what are the reporting implications? Is it for the transactions during the year, or is it at the year-end balance what one has to disclose? That is what this clause really talks about. And just to make it a little simple, what I have done is here the Y represents yes, it has to be reported in this particular case. No means there is no reporting implication. Similarly, here also Y and N in terms of the reporting, Y means a yes and N means a no. And this PB actually refers to where the principal business is actually giving loans, something like NBFCs, etc. So the very first clause which talks about the aggregate of transactions during the year and the balance which is outstanding for subsidiaries, joint ventures and others. So this is applicable for all balances outstanding as at the year end in terms of loans, guarantees, securities, investment. So in all 4 cases, if it's to a subsidiary, JV, associate or any other party, it would get triggered. Checking whether they are not prejudicial to the interest of the company. Again, it has to be for all because anything which is not prejudicial to the interest of the company has to be mandatorily disclosed by the auditor. It is just to bring in more transparency. Then in case the auditor feels it's prejudicial, actually the owners, because the public at large should be knowing what is happening in the financial statements because they're just relying on the signed opinion. Then whether the schedule for repayment has been stipulated. If there's actually a loan, then yes, there has to be a schedule of repayment, and therefore that's only yes here. There's a no in terms of guarantee, security, investment because there's no repayment there. If it's overdue more than 90 days, whether reasonable steps have been taken, yes, because for a loan it gets triggered and therefore it's a yes. If there's a renewal, extension or a fresh loan granted, again for loan it becomes applicable. And loans either repayable on demand or having no terms or payment period of repayment, specify the proportion, the loan to promoters, etc. Again the loan has to come. So therefore for clause C, D, E, F, guarantee, security, investment is not really relevant. However, having said that, for all these clauses, the transactions at the year end and the transactions during the year and the balances as at year end have to be reported. However, in clause C, D, E, for these three clauses, the transactions of the prior year also have to be reported as a comparative. So this is what a brief summary of whatever is given in the guidance note in terms of all the relevant clauses. I've just tried to populate it for the benefit of the practitioners. Moving ahead, again with the same clause, what all one has to see is to obtain a party-wise details of loans, investment guarantees, various forms which are filed with ROC actually talk about these MBP 1, 2 and 4. One can read that, use that to see if there's anything which is sitting there which could be, which one could really see to be reported or not. Reconcile the schedule with the related party transactions, the total loans which are there, then evaluate the rationale and the understanding of the end use of money. It should not be just round tipping, right? That one gives to the other gives to a third party. There has to be a rationale behind it. Then for loans, appropriateness of the interest rates, are they prejudicial or not? The extensions, renewals, what are the actions taken? Is there any advances without a purchase order? Also then as required under SA 250, check for any non-compliances within the Companies Act and the various directions of the RBI, etc. So all of this has to be carried out as part of the audit procedure. Then in terms of points to ponder, at times one makes a very narrow interpretation of the clauses. So therefore, that should not be the case. It has to be read in conjunction with what could be the triggering clauses that get impacted in case there's a adverse remark in this particular clause. Then professional skepticism and professional judgment is the key for any opinion which we are giving. Also, at times what has happens is one thinks it's contradictory in terms of reporting to the interrelated clauses, but it's not the case. Every clause is very unique. If one talks about repayment, the other talks about the probably if it's more than 90 days or not. So it's very unique, probably to be read in conjunction with each other. Then not considering the loans which have been squared off during the year or advance in nature of loans, that should be considered. And also at times one ignores the amounts which have been written off in the books of account, which should not be the case. Because if it's a loan which has been written off, someone would really want to understand why is that the case. In terms of revised schedule 3, what are the reporting requirements with respect to the clause 3 talking about investment guarantee securities is that the additional information has to be given which talks about where the loans or advances in the nature of loans are granted either to promoters, the key managerial persons, probably severally or jointly with the other person, are they repayment on demand. If we even don't want to specify the term of period of repayment, the disclosure should include the type of borrower, what is the amount of loan given, the percentage of loans and advances. Apart from that, the relationship with stock of companies. Probably if there's a loan or something given to a company which is in stock of stage, then that has to be disclosed because it's about balances being disclosed with the stock of companies. Then compliance with the number of layers of companies. Since it talks about two companies, subsidiaries, etc., so there has to be a limit in terms of the layers which the Companies Act stipulates. It cannot be more than that because then it would be a non-compliance. Then whether the company has advanced or loaned or invested funds to any other person, including a foreign entity, in such a way that the intermediary shall actually give this money to a third party who would be the ultimate beneficiary, or probably any guarantee or security on behalf of the ultimate beneficiary where the company shall say that yes, the amounts and the complete details of each intermediary, why the funds were advanced and what would be the ultimate detail, what would be the complete details of the beneficiary. And then if it's on the behalf of them, whether it's in contravention of the FEMA provisions or if there's any violation of the Prevention of Money Laundering Act. So all of that has to be disclosed as part of the additional regulatory information. Clause 3.4, which is what was there earlier also, which talks about section 185 and 186. 185 actually does not really talk about loan which is given to a wholly owned subsidiary or a guarantee to a subsidiary, but 186 holistically covers all kinds of loans, guarantees and securities. And therefore, if there's any non-compliance in terms of these two sections, all the details have to be disclosed by the auditor. Again, the idea is to bring in more transparency, ensure that yes, the people who are relying on the signed opinion, they're getting a true and fair view. Controls relating to compliance with laws and regulations is part of the internal controls. One has to test that. Then evaluation of loans. What are the steps followed by the management and those charged with governance to ensure that yes, they are complying with section 185 and 186. And at times we need to have a substance over form consideration. At times some things cannot be just taken in spirit as to what we see in writing, but the interpretation and conclusion using professional judgment and skepticism has to be done. The
Neha ji,
audit
I have a
procedure.
question here.
Yes, sir.
The question is, at times we just have entries in the books. We find entries in the books, there is no loan agreement.
Right.
So it's very difficult to find out what was the purpose, why it was given. So in such
But,
cases, what to do?
but if there are just entries and there is no loan agreement, so essentially there's no loan, right?
So where to include such items?
It would be normal receivable and payable. I mean, what I'm understanding from the question is, if the scheme of
Yes,
entries which are being parked from for receiving and paying something, I'm assuming
yes,
it's a
yes.
normal trading transaction. There's no loan agreement backed by it. So in substance, it's something which I need to receive probably in due course of my business and normal course of business.
No, but that is also not the scenario. The company has not sold anything.
There could be some trading activity because of which they would be receiving money. Otherwise, why would somebody pay to a company?
They
I'm just
say it is in
thinking
the nature
aloud.
of a loan. They say it is in the nature of a loan only, but there is no agreement to back it. And we have been facing this issue with income tax department also, because department also asks at times, give you substantiate these entries, and we are unable to substantiate the entries by way of agreements, etc.
Correct. So in those cases, it would be recommended that they should bring an agreement in place. Primarily, one because of the income tax department, and secondary, assumingly, if it's a foreign transaction, then the transfer pricing authorities also are going to challenge that. So one has to be careful about that. So in case company knows that yes, it's a loan agreement, better to have a backup document arranged for that.
Okay, thank you. Please continue.
Yeah. Then in points to ponder, at times what happens is there are no adequate disclosures in the financial statements in terms of the purpose of the utilization. So one needs to understand that what is the purpose for which it has been utilized, and the other is where the loans given at interest rate are lower than the prevailing yield government security loans. So in case the company is lending loan at, let's say, 7%, whereas the market rate is 9%, obviously it raises doubt amongst the audit. When we do the audit, it raises doubt that why is it that you're giving a loan at 7%, whereas market is going to pay you 9%. You're going to really lose 2%. Does not it trigger something to say it could be prejudicial to the interest of the company? Yes, it could be. So probably clause 3.3 would also get triggered there. So that's how the clauses have to be read in conjunction with each other. Then again in clause 185, 186, the reporting requirements, where one says that if there's any loan advance which is given to the promoter KMP, we need to disclose whether it's repayment on demand without specifying the terms of the period of repayment, the type of borrower, the percentage of loans given. If the loan is with the struck off companies, it needs to be disclosed. If they have advanced or loaned or invested funds to any other person, including a foreign party, again, Rule 11E and F gets triggered, talking about the intermediary who will actually transfer this money to the ultimate beneficiary basis what the company asks the intermediary to do. And then the whole list of requirements where the ultimate beneficiary, where the company on behalf of the ultimate beneficiary needs to disclose the funds were loaned and what is the purpose for loans, what is the who's the ultimate beneficiary to whom it has been given, if it's not in violation with the money laundering act, etc. And then compliance with the number of layers of the company. So I mean, it cannot be negated at all that whatever the company act says, that has to be stipulated and it has to be done accordingly. Then clause 3.5, which talks about kind of deemed deposits also, and the section 73 to 76 of the Companies Act, and whether there are any deposits under this, and if not, the nature of the contraventions, if there are any contraventions, was there any order passed by the NCLT or the company law board. So in terms of the controls, one needs to see what is the process followed by the company to accept the deposits to comply with the regulations. Then in terms of the audit procedures, one can actually test the compliance with the regulations from their company secretary, what all compliances they do. If there is any deemed deposit, obtain the list of amounts received in course of the business, DPT3 filed by the company, which talks about the deposits and what all kind of deposits have been taken, have been actually accepted by the company. Then inquire with the management with respect to the regulations and whether they have received any orders from any of the relevant authorities. So all of this has to be done to ensure that the reporting gets captured appropriately. At times one ignores the orders which are received, which is not a good practice. One should see that. And also the identification and compliance with the regulations which are there. So that has to be done with. This has to be taken really care of. In terms of additional regulatory information, in case there's a deposit taken but it has not been returned within the stipulated timeline, company could be a willful defaulter. And then the another reporting requirement of stating whether the company is a willful defaulter or not gets triggered. And therefore this clause and this again another clause which talks about disclosing the details gets triggered. There are various websites actually when you do Google which tell whether the company is a willful defaulter or not, basis which one can see if it's true or not. As a part of a documentation, it would be a good piece to keep in the audit files. Then if there's any relationship with struck off companies under section 248 or 560, again if they have received any fund from the company or fraud entity, that the intermediary is going to lend it to the other person, and then rule 11E and rule 11F with respect to the ultimate beneficiaries.
जो निचोड़ने वाली जो आदत होती है ना वो हो जाती है, बढ़िया ही है.
Then clause 36, which talks about the maintenance of cost records under section 148 subsection 1.
काम हुआ तो
You are muted, Neha ji.
Neha ji, you are not audible. There is some issue.
I think mic was
Yes,
muted
now,
at the bottom.
yes. Now you are
Sorry,
audible.
sorry for that. Yeah. So I'll just briefly say I was talking about 148 1 of the Companies Act, which is very similar to what was there earlier. And the idea is to ensure that the company maintains proper cost records. It's again in the accounting package where we would have, where the company would have machinery, and where the cost audits are actually prescribed under the company's cost records and rules and the audit rules 2014. These cost records also have to be in align with what is sitting in the financial statements. The numbers have to match. In terms of audit procedure, one could really take the form CRA1, which talks about how the audit was done. Was there any specific observation or adverse remark of the cost auditor? So we cannot just ignore that. We need to take into consideration what all remarks were made by the cost auditor. If it is good to go, we can have that. In case they say if there was a qualification or adverse remark, then we need to appropriately capture it. So at times what happens is there's a qualification sitting in cost audit report, but when the statutory auditor issues the opinion, it just goes unnoticed, which should not be the case. So we have to give due consideration to what the cost auditor is also signing. Clause 37A, quite similar to what was there earlier also, except for the fact that it actually brings into purview, and the new CARO clause talks about the other statutory dues. Now the question would be, what are other statutory dues? So any dues which gets governed under a statute, let's say a central statute, a state statute, it would actually be a other statutory dues. So all undisputed statutory dues like GST, PF, income tax have to be disclosed. In case they are more than 6 months, in case the due date is like the arrears actually from the last day of financial year are more than 6 months from the date they became payable, then it has to be indicated in the CARO report. So one has to determine what are these statutory dues, what all statutes are applicable to that particular company. The industry in which that company is prevailing is also very much important. Then a tracker of activities. People do maintain a tracker saying one has to file GST returns on this particular date, TDS on this particular date. So companies do prepare a tracker to say that yes, they are in compliance with the activities. So, and also one can abide by the standard on auditing 250 about the compliances, then 315. Then the tracker can be obtained. One can understand the process followed by the company, that yes, they're following everything in good spirit. Everything is getting documented. And what happens really is when we actually sign the tax audit reports also, it says if there's any penalty, interest, or any statutory due implication, then whatever gets reported here would also become a trigger to what gets reported in the form 3CD also. So I've just brought that piece also here so that we as practitioners are really aware as to how we could link all the clauses together. And at times what happens is one needs to understand when it says the company is regular in depositing the dues. So one response could be yes, it is really regular. The other response could be it is generally regular when there are few delays or gaps. And the third could be the company is not regular, or probably they just don't deposit the taxes on time. So one has to really see what are the delays, are they abiding by the due date, do they don't meet the compliance requirements, and accordingly the reporting has to be done by the auditor. So the key here is actually identifying all the statutory dues which are applicable to that particular industry or company, which I think the management can tell the auditor best what all is applicable, what all compliances are there. Clause 37B, which talks about the dues which have not been deposited on account of any dispute, and where we actually take all the confirmations from the legal consultants, etc., to say where the in which forum the dispute is pending, what all is the status of the dispute, did we deposit anything under protest. So all of that culminates into the reporting requirement under this clause 7B. So the statement of disclosure can be taken, possibility of what is getting disclosed in Form 3CD in clause 41. What does the legal and professional ledger say? The rates and taxes ledger. Is there something sitting there which triggers the reporting under this clause? If there's an underlying demand or appeal order, one can go to the income tax website. It's so transparent. The companies can get to know what are the orders for which particular assessment year, what all is outstanding and where is it outstanding. So information can be gathered from there. And one should not just blindly copy paste what was there last year, but see what is the current development, what is the latest scenario, and then accordingly disclose. Clause 38, which is new clause, again a kind of a red flag clause to see that if there's any transaction which was not recorded in the books of accounts and now has been surrendered or disclosed as income during the year in the tax assessments, if so, whether the previous unrecorded income has been properly recorded. So kind of the secondary and the primary secondary adjustments concept in Form 3CD, which talks about clause 92E of the Income Tax Act also, where we say that yes, if there's unrecorded income which the company is saying that yes, it is there, to the income tax authorities, it's paying tax on it, it has to be brought back into the books of account. In case it is not, there has to be a reporting requirement. So as an auditor, what all documentation we can see to ensure that the report or the opinion which we are giving in this CARO is absolutely correct. One can actually review all the income tax assessments which have been completed, take confirmations from the legal consultants, see if there's any adjustment in any of the tax assessments, and then the appropriateness can be considered. So this is very key to understand. I mean, if there's any change in the tax returns which they have filed, if there's any XYZ amount which they are now surrendering, which was not there in the books of account, so that it can be captured back. And in terms of Schedule 3, there's additional information which has to be given under the details of the items of exceptional nature in the financial statements. One has to really disclose the details of the transactions which are not recorded in the books by way of a note saying that it was disclosed under the income tax assessment, and therefore these are the amounts which were disclosed, and therefore it is getting, one is recording it in the books of accounts, and whether the previously unrecorded income and the assets now are appropriately recorded or not. So that note in the financial statements as additional information can be given by the auditors.
Neha ji, I have a question here.
Yes, sir.
In case a notice is received from the income tax department, say by
Yes,
intelligence,
sir.
from intelligence unit, and sometimes they do not reflect such notices even in the profile,
Correct.
because they are gathering information for say Black Money Act or some other act, and
Correct.
based on the initial inputs they then start the proceedings or just drop the proceedings. So whether we
True,
should
true.
take note of such notices also or not, what is your view on that?
So that would be kind of notice under section 142 of the Income Tax Act, which just says that since we are doing a preliminary assessment, so the assessee has to deposit ABCD. They ask for a whole lot of things to really start the proceedings and make a
Yes,
judgment
yes.
whether what they have submitted as tax. So I don't think that notice of 142 should be counted. However, when we
Okay.
receive notices under 143, 3 or 4, the best summary and the other assessments, wherein they
Yes, yes.
actually talk for about demand, etc. But primarily, what I have seen in based on my experience, it's primarily with what is already recorded in books. It's just that the allowances and disallowances change basis which they pay the taxes. I
Mhm.
have not really come across a situation where the company has disclosed something, uh, I mean, bona fide to the tax authorities. But having said that, the very rationale of including the secondary adjustments in the Form 3CD with respect to the transfer pricing was because of this only. So probably they're just trying to ensure that the dots get connected to each other.
Okay, thank you. Please continue.
So here, section 158B of the Income Tax Act, which talks what is the undisclosed income. It could be either in terms of the money, bullion, jewelry, or any expense deduction claimed which was found to be false, wherein we would any which ways have a demand sitting for that. And if it is not recorded in the books, and any transaction which is partially recorded or recorded at incorrect amounts, then this undisclosed income which was not recorded gets to be recorded, and the voluntary surrendering during the year until the date of the audit report has to be covered. Moving ahead with clause 3.9, again it has three components. 9A, which talks if the company has defaulted in the repayment of loans or borrowings or in the payment of interest thereon to any lender. Now, since the word any lender is given, it would include anything under the sun in terms of companies, LLPs, banks, financial institutions, related parties also. Because it says any lender, it is not really focusing if it's a related party or a non-related party transaction. So one needs to see what are the due dates for the principal and interest payments, whether the company is abiding by that. Is there any default? What is the reason for default? Blindly making 1 or 2 days delay, it cannot really trigger a reporting requirement, but one needs to understand, apply that judgment, see substance over form as to what was the reason of the delay, and then confirm the accuracy with the books, what is sitting in the books, the sanction letters of the banks. Then if the repayment is made after 2 days, then how the pattern is like, the company has often been regular, it was just one-off case or not. So all these considerations have to be kept in mind while seeking what needs to be reported under this section. And borrowings, sorry, yeah, borrowings would include both long-term and short-term in the nature of term loans, demand loans, cash credits, overdrafts, even non-fund based credit facilities. And in terms of the reporting requirement, what I mentioned in the initial slides talking about the Schedule 3 additional information, Schedule 3 reporting requirements, which are more in the nature of the reclassifications from the non-current to current or probably to financial assets. That is what is required, and the very much format of the financial statements is already given in the Schedule 3 guidance note. So one can just rely on that and can just make the disclosures wherever needed. In terms of clause 3.9b, whether the company is a declared willful defaulter by any bank or financial institution or other lender. In terms of internal control, one needs to track what are the defaults, if it's a defaulter, and what are the reasons for the same. Then what are the internal control deficiencies that led to the management override of controls, if there's any transparency in the financial reporting. In terms of the audit procedures, one has to inquire with the management on whether the declaration as willful defaulter, check websites of RBI and credit information companies such as CIBIL, etc. for any declaration as willful defaulter. In case of defaults in repayments, either during the year or in subsequent periods, obtain the confirmation from lenders whether the company has been declared so. Even if the company has not been declared a willful defaulter, but a show cause notice report has been given, then that has to be disclosed. Evaluate the implications of default on the viability of the company's business, its going concern, and fraud risk. Let's say if the default is very much frequent, it just keeps on happening, there could be a trigger to say that the company does not have adequate funds to pay, and therefore the going concern or probably the liquidity position would be very loose. So that actually again has a trigger to SA 570 on going concern, and accordingly a probably material uncertainty or a NEOM paragraph, whatever the case may be, would get triggered. Then the points to ponder is in case of continuing default as at the balance sheet date, not auditing the information of the subsequent period. So when we see, we have to see the holistic picture, what happened till the year end and what is really happening after the year end also. Does that really continue? Then in terms of the revised Schedule 3, the additional regulatory information which talks about whether the company is a willful defaulter, again that note has to mandatorily come. Then the date of declaration, whether the company declared it's a willful defaulter, and all the details of the default would get disclosed. Clause 3.9c, whether term loans were applied for the purpose for which the loans were obtained. If not, the amount of loans were diverted and the purpose for which it is used may be reported. So in terms of internal controls, oversight of board, so just a second. Then oversight of board, monitoring the utilization if it is in line with the terms sanctioned. Then appropriate level of authorization depending on the nature of utilization. In terms of the audit procedures, we can obtain the cash flow schedule for the borrowings, check the accuracy of schedule with the underlying bank statements, understand the terms of utilization for each loan and whether the funds were utilized for the purpose for which they were taken instead of utilizing them for the other purposes. Then consider the further audit procedures as are necessary to address the additional risk, let's say significant payment to a related party soon after the loan was granted, exceeding the budget submitted to lenders. So probably to a lender, I said that okay, this is what I would be receiving, but when it comes to me giving this loan to a related party, it's way too higher. So all these have to be really considered while one thinks what needs to be reported here. And at times what happens is we just rely on the management representation that this is what they are saying and this would be the true, but the reasonable test has to be carried out to say that what they are saying holds truth. Yes, what they are saying, there's a documentation backing it, so all of that has to be disclosed. Then in terms of revised schedule 3, we need to disclose separately that whether the company has not used the borrowings from banks for the purpose it was taken, but for a separate purpose altogether. So that has to be called out and disclosed. The management has to work on it that if there's something received in this bank account, then it has to be utilized for this purpose. They have to have that documentation with them. If not, then the factual statement has to get reported in CARO. Then where company has received any fund from any other person or entities, including foreign entities, with the understanding of that ultimate beneficiary rule 11E and 11F get triggered, then all the details, since it's a transaction where 3 parties are involved, where the ultimate beneficiary would be totally a different party altogether. So what is the details of the party, whether it's in accordance with the Companies Act and the laws and regulations, it's not against the Money Laundering Act, etc. All of that needs to get captured. Then clause 9D, where the funds raised on short-term basis have been utilized for long-term purpose, the nature and the amounts are indicated. So this clause also is a trigger to the going concern indicators also, where one needs to see whether the long-term source of funds exceeded the application of funds. Long-term sources would be the share capital, reserve surplus, long-term debts and securities. And the short-term application of funds would be anything which is not long-term in nature, whereas long-term application could be investment in property, plant, equipment, intangible assets, long-term assets. So if the ratio is little skewed or probably it's less than 1, it is an indicator that short-term funds have been used for long-term purpose, and probably the viability of the company to continue as a going concern could be a question. So therefore, this kind of a working has to be done to evaluate if this could be the case or not. The guidance note has beautifully explained what all considerations have to be there, how one can evaluate if some adverse remark has to be given or what kind of a remark needs to be given in a particular scenario. In terms of revised schedule 3 to be disclosed separately, where the company has used the borrowings for a purpose with which it was not taken. So again, if the use does not match for the reason it was taken, it has to be disclosed. Then clause 39E, where the company has taken funds from any entity or person on account of or to meet the obligations of the subsidiaries, associates, JVs, details thereof with the nature of such transactions and the amounts. So what happens at times is the company has taken a fund, but it is only to give benefit to the subsidiaries, again to the related parties. So in that scenario, what happens is the auditor should actually see how the board is really managing the affairs, how the board is monitoring what has been taken and what all is passed. Then the appropriate level of authorization, are all these transactions approved and authorized by the board or not. In terms of the audit procedures, verify the purpose of utilization of all the loans to check if the loans were taken to be utilized for meeting the obligations of the subsidiary, or if there's any other payment on behalf of entities were used out of the borrowed funds. So in case of Schedule 3 reporting requirements, again, since the funding was taken for some other purpose but utilized elsewhere, it has to be disclosed. And since again it's a third party transaction, one is taking money from the funding party and the company being the intermediary then gives it to the ultimate beneficiary where it acts on the whims and fancies of the company which is lending. Then whole lot of requirements, again talking about if it's in compliance with the FEMA Act or probably the Prevention of Money Laundering Act, the details of the funding party, who's the beneficiary, all those details have to be disclosed. Then clause 39F, where the company has raised loans during the year on the pledge of securities held in subsidiaries, joint ventures, if so, give details. So at times where the loan is raised and the pledge is given of the securities of the subsidiaries, etc., then the minutes of the board of meetings can be verified to see the pledge of the securities which has happened. One could verify the term sheets to check the nature of the security and required to be pledged against such loans. Then verify the documents related to the charges created, including the modification, or confirm if there's any securities which is held in the subsidiaries, JVs, or associate companies which have been pledged. And in terms of additional reporting requirement, since there's a default which has been done by the company in terms of the repayment of such loans, one needs to check, is there a trigger that the company becomes a willful defaulter? If yes, then the details of the defaults have to be disclosed. So this is the Indian Contract Act, and what all is the definition of these securities, again reproduced from the guidance note on CARO. Moving ahead with clause 310A, which talks whether the monies have been raised by way of initial public offering or further public offering during the year were applied
Just
for
a
the
minute,
purpose.
just a minute, Neha ji, just a minute.
Yes, sir. Yes, sir.
A question on default. Suppose there is a default, but that has been made good, then what to do? There was a default, but then the company paid. So in such a situation, whether
Then
to report or not?
So exactly. So one has to see is twofold. One, it was only one of the case. Either to the company has been making it on a timely basis, then substance over form, it can be given credit. Then okay, it was not really a default. It happened by chance, something of that sort.
Okay.
So again, judgment would come into picture. But just for one thing, the entire, you can't blame the company for not doing it entirely.
Okay. Thank you. Thank you. Please continue.
Whether money is raised for initial public and for the purpose for which they were raised. If not, the details together with delays or default and subsequent rectification as may be applicable be reported. So what happens is one has to see the compliance of Section 40 of the Companies Act and SEBI requirements, the oversight of the board which is monitoring the utilization of the funds, because if the public offer has been made, the money which is coming has to be used for a specific purpose, and if there's a deviation in that purpose, then if the details together with the default, what are the delays and the subsequent rectification, all has to be given. It has to be duly authorized, examine the offer document to understand the use of the money, and also the reports of the institutions, if any, appointed which is monitoring the fund. So if there's a third party who's appointed who's going to monitor that, yes, please ensure that the intended use is same as what, the actual use is same as the intended use, then please do let us know, so that the third party which is hired would be monitoring all the funds. And as part of Schedule 3 reporting requirements, again, since it's talk about the offer and what has been received in terms of the funding, so any fund which is received, Rule 11E, Rule 11F get captured, and all the reporting requirements of the additional regulatory information which has to be given gets triggered in this particular clause as well. Clause 10B, as compared to 10A, which talks about the public offer, this talks about the preferential allotment, where there's a preference given to the shareholder, or probably the private placement where it is given privately to a pool of people. So in this particular scenario, if this is done, whether the requirements of 42 and Section 62 of the Companies Act have been complied with and the funds have been used for the purpose for which they were raised, if not, the amount and the nature of non-compliance. So everywhere they're focusing on what was the purpose. If the purpose is met, well and good. If the purpose is not met, what is the amount and what is the kind of a deviation. So all that has to be mentioned. Then who is monitoring the fund, what is the utilization, the appropriate level or the authorization of the funds, the documents which one can verify as an auditor could be PAS code documents which are filed with ROC, the explanatory statement which is annexed to the notice of the general meeting to understand the proposed end use of the money raised. And in case the specific purpose is not recorded and the general purpose or probably the bona fide business use are stated in such cases, then one has to verify whether the company has invested or utilized the money for general purpose or bona fide business use of the company. So whatever is stated, it has to be one has to abide that in true spirit. So there cannot be any deviation on that. So private placement, I already explained, is to a select group of persons by the company, and preferential is issue of shares on a preferential basis. Then clause 311A, my favorite in fact, which talks about whether there's any fraud by the company or any fraud on the company which has been noticed or reported during the year, then what is the nature and what is the amount involved, and what are the reporting implications. So section 143(12) of the Companies Act, and also there's a standalone guidance note which is issued by the Institute of Chartered Accountants of India on the fraud reporting requirements, and that's a guidance note under 143(12), which is again beautifully carved out, which says what all has to be discussed, what all is the auditor's responsibility, what all is management responsibility, then what is the use of forensic experts there in case there's a fraud, what is the limit which is there in the act after which we need to report it to the central government. So all those responsibilities are defined therein. The guidance note also talks about a checklist which the auditors can use for the inquiries of fraud with the management, etc. So all that is laid down there in the guidance note. So the internal controls, it talks about the controls that address the fraud risk. What all controls the company has over the significant unusual transactions that result in late or unusual journal entries. What are the controls around the period and financial reporting process of the company? Controls over related party transactions, because I mean, if one would have seen, there's very much emphasis being laid on the related party transactions. Then the controls related to management estimates, probably controls around mitigating the incentives pressures on the management to falsify or inappropriately manage the financial assets, could be misappropriation of assets, embezzlement of cash. So all that gets covered here. What all controls the management has, auditor needs to understand that what all controls are there. In case there's any deficiency, is the management really willing to rectify that, or probably what is the tone and tenor of the management is something which the auditor can see. In terms of audit procedures, one should have the inquiries with management, those charged with governance, internal audit function, and other persons to ensure that there's a segregation of duty. There are legal counsels, there's a chief ethics officer, there are persons charged if they are dealing with any allegations of fraud. Then the operating personnel does not get directly involved in the financial reporting process. Maker checker process exists. Then there are minutes of meetings which take place. A list of whistleblower complaints are maintained. There's a proper committee or a desk which handles all the whistleblower or the fraud complaints. The reports issued by the internal auditors, the cost auditors, secretarial auditors, all are really considered taken in true spirit, and it's not just a tick in box exercise which is done by the management. Then standard 240, which refers to the information gathered from the risk assessment procedures to ensure that there are no fraud risks which indicate that there's any incentive or pressure wherein the management would resort to any kind of fraud. There's no opportunity to carry out any fraud. The attitude is not such. And the compliance of standard on auditing 240 till the date of the audit report. So considerations which the guidance note talks about is that one should not just really rely on the representation from the management, but actually use professional judgment, skepticism while performing the audit procedures. In case there are frauds which are noted by the management, which are huge and they involve the forensic investigation reports, or what does the report say, what is the conclusion drawn in the report. So auditor has to read that to arrive at what all has to come here as a factual statement in the CARO reporting. And in terms of additional regulatory information, if there's any cryptocurrency trading done by the company or virtual currency, then all of that has to be disclosed. What was the profit? What is the advance in currency, etc. In terms of clause 39B, which is emanating from the earlier subclause about the fraud, so it says that under section 143(12), the Companies Act, the auditor has to inform ADT4 as prescribed under Rule 13 with the central government if there's any report which is filed, since the considering that the fraud is for 1 crore or more, those details have to be mentioned here. So one has to see, was any fraud detected by anybody? Was there any allegation against the vendor, the customer, the employee, the consultant, or the contractor? Did the predecessor auditor, did he notice any kind of fraud which is happening? The incoming auditor, when we send a no objection certificate to the predecessor auditor, did we notice something which the predecessor auditor wants to tell us? In the secretarial audit report or the cost audit report, is there anything which has been specified with respect to fraud? Or if there anything we noted as an auditor, considering the guidance note of reporting on fraud under 143(12), so one has to keep eyes and ears open to see if there's hunky-dory which is happening within the company. Then clause 39C, where the auditor has considered whistleblower complaints, if any, received during the year. So if there's a whistleblower policy which exists within the management, and if they've received the complaint, who receives the complaint and who takes action on the complaint, they have to be different people. Then it should also be the case that if the management receives a whistleblower complaints, who's really going to look at those complaints? So all that has to be considered. What is the process, how the complaints are understood by the management, and then the action is taken. They're not just dusted off completely. All has to be seen and documented. And as an auditor, we need to see, once we understand the process, that as an audit procedure, we tested these complaints were received, they have been disposed of by XYZ person in the management or in the company. These are the conclusions, and they do not have any financial impact on the operations of the company, and therefore no financial reporting implication. So all of that has to be read, studied, and then it has to be disclosed. Then clause 312, which talks about Nidhi company, which says that it is compliant with the ratio 1:20 for net owned funds to deposits as per the law governing the Nidhi company, which is the Nidhi rules 2014. Then if they are maintaining 10% unencumbered term deposits to meet the liability, and if there's any default in the payment of interest. So one needs to understand what is the process of complying with this regulation of 1:20. And then when they talk about the net owned funds and the percentages used for unencumbered assets, how do they really compute that 10%? Then the completeness and accuracy of the statement, do they comply with the rules or not? The details of the Nidhi company get furnished in form NDH3, which is a half yearly return. One can see that to see there's no discrepancy in what is getting submitted and what is sitting in the books of account. Then examine the schedule of payment of interest and the deposit with terms to the payment to see if there's any default or not. Clause 313, which talks about section 177 and 188 of the Companies Act, primarily from the related party perspective. So again, being a key critical audit area, related party transactions, completeness, one has to see if it's at arm's length or not, because that's what the reporting requirement is. Comparing the terms of transactions to the known market terms for similar transactions in the open market. Then the evaluation to see the nature of the transaction, the business purpose, frequency, pricing, etc. So it's similar to what was there in the earlier CARO also. So this paragraph 825 of SA 550, which is on the related party transactions, it actually lists down few examples of transactions which are outside the entity's normal course of business. And therefore, while doing the audit, one could actually test all these transactions to see there's no bias involved here and nothing is outside the normal course of business, but it is within the normal course of business. In terms of the disclosures in revised schedule 3, which get triggered from the clause 313, is again the loans and advances in the nature of loans to promoters, directors, KMPs, all are related parties, so that has to be disclosed. If there's a struck off company which is a related party, any transaction with that would get triggered. If there's any fund which has been received from a foreign funding party, if that foreign funding party is a related party, again it would get triggered. So here the key focus is wherever any funding received, given all the transactions, but it has to be mandatorily a related party. It has to get disclosed under this particular clause. And then if there's any advancement or loan which is given, again, the ultimate beneficiary, the details of the beneficiary, everything has to be disclosed. Yeah. Moving ahead with clause 314, which talks about the internal audit system. The first question it asks is whether the company has an internal audit system which is commensurate with size and nature of business, and whether the reports of the internal audit for the period under the audit were considered by start auditor. So section 138 of the Companies Act defines in which all cases the company needs to have an internal auditor. Once they have the internal auditor, they need to draw a chart what all account balances or areas would be covered in which particular year, what is the time period of getting the internal audit done. As an auditor, we are supposed to take all those internal audit reports, evaluate that yes, they're commensurate with the size and nature of the business. If it's a big company, what would be the frequency? How are they going to scope in various account balances, or probably scope in various locations, as the case may be, as the industry would be. Then once we get those reports, whether they actually cover the year under audit. Let's say if we are issuing a report for 22, do they really cover FY 21-22, the year under audit, if everything is getting captured there? The entity level controls, the audit committees, board's evaluation of the independence, competency and objective of the internal auditor. Is the start auditor going to rely on the work of internal auditors? Again, a separate standard on auditing there, which says that if you're going to rely, what all we need to do. If you're not relying, at a minimum, we need to ensure that the person who's carrying internal audit is competent. There's no familiarity threat or an independence threat to that person. And then the review of the internal audit report is done by the management. The management responses are submitted to them, saying that the course of action or probably the revision which they are going to do in case there's any observation by the internal auditor or any weakness which is highlighted by them. So start auditor needs to peruse all those reports and give a reporting requirement here. The guidance note actually stipulates 3 conditions saying when is the internal audit applicable. If the internal audit is not applicable, how would one answer the question on commensurate? And a situation C, how would a reporting be if none of it is applicable? So all 3 situations are clearly laid down in the guidance note with the reporting which the auditor can give. So the auditor can actually use that language while opining. Clause 315, which talks about non-cash transactions with directors or persons who are connected with him. So this is actually with directors or persons who are related to directors. Non-cash transaction would be anything where there's no dealing in cash. Something like the assets are getting transferred to a director without any consideration. So that is a kind of a non-cash transaction. So one has to see what are the controls identifying the connected people to the director, then accuracy of MBP4 wherein they disclose all the interest, etc. Review the controls over secretarial compliances. How are the compliances getting taken care of? In terms of the non-cash transactions, how the approvals are taken within the management. There's a preparer, reviewer. Is the resolution passed at the general meeting? Then how's the completeness tested? Is there any transaction which happens but gets unrecorded or unnoticed in the financial statements or in the books of account? How is that recorded? The scrutiny of the transactions, whether the forms which are filed with the ROC are inspected, the minutes of meetings are being reviewed. So everything has to be seen. And yes, substance over form is like prerequisite that is given. So this is brief on section 192, which says who all are covered, which says the director of the company, the holding subsidiary, the associate company, or any person who's connected with him. Any person connected would be in terms of with whom the director of the company is really interested. So that gets triggered here. And the requirements also say that a prior approval of by a resolution of the company in general meeting has to be taken. The director is a director of the holding company. Approval shall also be obtained by passing a resolution in the general meeting. So all these compliances of section 192 which are given in the act has to be complied with. Then section 3, subsection 316, which talks about one, if the company is required to be registered under section 45 IA of the RBI Act. Second, whether the company has conducted any NBFC activities. Third, if the company is a core investment company defined under the regulations by the RBI. If yes, whether they fulfill the criteria of a core investment company. And if the company is exempted or unregistered, whether it continues to fulfill such criteria, and whether the group has more than one CIC as part of the group. So here one needs to understand what is the requirement of the NBFC. What does the section 45 1A says, whether the company is required to be registered there or not. Then which it says whether the group has more than one CICs. So as an auditor from the group team, so let's say there's a main parent company and then there are subsidiaries, associates within it. So for the group structure, basis the group structure, the auditor needs to understand if there are more than one CICs which are part of the group. And then it has to be disclosed who all are in there, and that as a part of audit documentation should be retained by the auditors. Then as audit procedures, assess whether the 50% of the total assets gross income is really a map, because that's the key here to see if the company gets triggered under section 45A or 45 1A of the RBI Act or not. Then the threshold for the investment entities categorized as core investment companies, whether it's classified as core investment company and it continues to fulfill the criteria, or if it's an exempted unregistered CIC, does it still fall under such criteria? So all those once we have a list of CICs which fall under that group, one can identify which all are functioning under which particular subclauses, whether it's in C or D. Then obtain a written representation from the management about CICs within the group and to the extent registered corporate with the RBI website. So the guidance note actually has given a link to the RBI website where we can go and we can type the name of the entity. It tells whether it's a core investment company or not. And once we know if it's a core investment company, the group to which that company belongs to, we know that yes, it's the group. So how many CICs are there in the group, and therefore it becomes easier to report under this section. So one has to ensure that yes, the completeness is there in terms of identification of CICs. One is the RBI website, then we can understand from the management, the group structure, how many CICs are there, and then again a representation letter from the management. Clause 317, which talks about the cash losses in the financial year, and in the immediately preceding financial year, the amount has to be stated. So the guidance note actually says that how the determination of the cash losses has to happen. Merely taking cash flows from the operating activities cannot be constituted as a cash loss, but there's a defined formula how one can compute cash loss. And the guidance note briefly in few paragraphs explains what can be added back or what can be reduced after taking the cash losses. So something like depreciation, diminution in the value of investments, lease amortization, unrealized gain loss, all these can be considered and probably could be either additive or subtractive items to arrive at the cash losses. As a factual statement, whatever formula is being used, one can really state that, because this would be really a little subjective to understand what all should be added and reduced basis the plain reading of the guidance note. So one can define that what all elements were added and reduced to identify the cash loss. Then clause 318, which talks about whether there's any resignation of the statutory auditors. If so, whether the auditor has incoming auditor has taken into consideration the issues, objections, concerns. So wherever there's an appointment of the new auditor and the old auditor is going, so we need to really understand and issue request an NOC from the predecessor auditor. We need to ask them if there are any objections wherein they believe that we should not accept the appointment. So the incoming auditor under the ethics also should be doing that, and inquire with the predecessor auditor if they believe there are any reasons or concerns, and then probably leverage that to understand whether it impacts the risk of the engagement, or probably would you really want to do that audit or not. So all that considerations come into this. Is something which we have been doing it, but CARO specifically wants auditors to comment on this. Then clause 319, which talks about the financial ratios, the aging and the expected dates of the realization of financial assets and payments of financial liabilities, other information in financial statements, the auditor's knowledge of the board of directors and management's plan, whether the auditor is of the opinion that there is no material uncertainty as on the date of the audit report, and that company is capable of meeting its liabilities as at the balance sheet date. So how one can understand and comprehend what needs to be reported in this clause is, there are various financial ratios which one can compute, like current ratio, liquid ratio, cash ratio, efficiency ratios, turnover ratio. Once we compute the ratio and we have the previous year numbers also, one can compare how the company is performing. Does it have a trigger on the going concern? Then what is the date of realization of the assets and the payment of the liabilities? Does the company have adequate funds to pay off its obligations and meet its obligations? Then if we see that the company is into consistent losses, the short-term funds being used for long-term purpose, what is the management plan? Do they have a growth plan? Would they be in profits in the next 3-4 years? Is there any big impairment hitting the company which would not wherein the going concern becomes an issue for the company? So all of those considerations are very important, and even SA 570 lays down the operational financial indicators wherein the going concern would be a question, and how the support from the parent can be taken, and then we can arrive at a different conclusion to say if they keep on receiving the continued support, they would be a going concern entity. So all these considerations, and duly keeping into mind SA 570, one needs to report under this that yes, it's good to go or not. Then the various ratios which are required to be given in Schedule 3, partially which comes from this going concern financial ratios, almost 11-12 ratios, and it says that two things which are very much important here is the formula which is given in the guidance note. One can use that formula and can specify what all has been included, excluded, for more clarity for the users of financial statements. And secondly, if the ratios are actually the variance in the ratios, if it's more than 25% as compared to the preceding year, due explanation has to be given as to why there's a variation. Then clause 320, which talks about the corporate social responsibility. Part A talks whether in case of the in respect of other than ongoing projects, the company has transferred the unspent amount to a fund which is stipulated under Schedule 7 to the Companies Act within a period of 6 months. And the other says that whether any amount remaining unspent for an ongoing project has been transferred to a special account. So this is something which I have plotted in the table, saying that if there's an unspent amount for an ongoing project within 30 days, it has to be transferred to a special bank account which is unspent CSR account. But if it's another than ongoing project, or probably where the project has actually happened within 6 months of the expiry of the financial year, it has to be transferred to a fund under the Companies Act. So if this is not followed, it is a non-compliance of the section 135 of the Companies Act. And if there's some unspent amount which is there, there has to be a provision because the company has to spend that amount. So what all is required under section 135, 5, 6, the latest rules which have come under. So one has to read that, understand from the company where are they going to really have those CSR activities carried out, whether the activities would be in accordance with what is stipulated in the rules and the Companies Act, because there are a whole list of things like education, empowerment, etc., where they say that yes, one can spend and claim the CSR benefit. So that has to be seen. In terms of internal control, how the management minimum CSR spend, how compute that, that needs to be seen. Whether it is within the timelines, how do they monitor the spending and the budget? Then what is the appropriateness of the disclosure of the financial statements? So this is something which one can check. And in terms of audit procedures, one can see the minutes of the CSR committee, the minutes of the board meeting, how they are discussing the CSR, how proactive is the company in terms of CSR activities, there's a separate bank account or not, whether there's a money which is earmarked specifically for CSR activity, whether they have been utilized for what is stipulated in Schedule 7 to the Act, and then whether the conditions of Rule 4 of CSR Rules 2040 are met or not. So all of this has to be disclosed, and one needs to see that whatever is disclosed in the director's report, because director responsibility statement also they cover CSR. Whatever is there, it's appropriately captured by the auditors also. It has to be in sync. Then in terms of CSR only, what all are the reporting requirements under Schedule 3? It says that where the company covered under 135 following has to be disclosed: the amount required to be spent by the company during the year, the expenditure which they incur, what was the shortfall, total of the previous year shortfall, why did the shortfall occur, why did they not really pay it, what was the nature of CSR activity, the details of the related party transactions, the contribution to the trust controlled by the company in relation to CSR, whether there's a provision made to the liability incurred by entering into a contractual obligation, and that needs to be shown separately. This is the last clause which is applicable for the consolidated financial statements, which says that in case there are any qualifications or adverse remarks which are given by the auditors of the standalone companies, or probably the components if it's a group audit under the CARO 2020, and if yes, the details of those companies and the paragraph numbers of the CARO report containing the qualification or adverse remark have to be captured in the consolidated audit report. But what it explains is that what would be the definition of qualification or adverse remark? It says that merely giving a qualification or adverse remark under the SF 705 revised, which talks about the modification to the audit opinion, merely going by that, it would not mean it's adverse or an unfavorable remark. But if there's something, something like a failure of the company to deposit provident fund could also be an adverse remark, probably due in default in repayment of loans or borrowings. Again, it could be an adverse remark. So the CARO 2020 specifically has asked the auditors to give their responses in affirmative or negative. Entire reading of the component audit report has to be done to see which all clauses would need a reporting requirement under 320, 321 to say that the standalone had an adverse or adverse remark or a negative remark. Secondly, when it's a group audit, what the auditor sitting at the main group audit can send instructions to the component auditors. They can take what all component auditors feel are adverse remark which should be highlighted in the group audit report. That can be done. Even the parent company would become the group audit, and then they would have their subsidiaries which would be component audits. So anything which is disclosed in component audits in terms which, using their professional judgment, if it is seen that yes, it's either in negative or something which needs to be disclosed, then that can be captured appropriately by the parent company. So that all has
Neha
to be
ji,
seen. हाँ जी
Neha ji,
सर.
I have got two questions here. First
Yeah.
question is, at times the financial year of the company which is situated abroad is different.
Hmm.
This is one issue. And another issue is at times there is a change in the management, even the name of the company changes. So, what to do in such a scenario?
So, if I were to talk about first scenario where the year end is different, so it is
Yes,
likely that you would not have received the financial statements of the component which is outside
yes,
India.
yes,
So
yes.
again, that fact has to be reported that this is one of the subsidiary or the component of the company. We have not been made available the financial statements of that company, and therefore we are unable to really comment. And in terms of the second, where we say that the management has changed, the question would be, if
Hmm.
the management has changed, is it still a subsidiary or is it not a subsidiary? Would it really get captured under the consolidated standalone financial statement understanding or not? If the answer to that in the decision box is yes, that even if there's a management change, it still remains a subsidiary, this clause would get triggered. But if the owing to change in management, it's no longer associated with the company in any form, then this would not really get triggered.
Actually, what happens is at
Hmm.
times there are two managements in the foreign company
Okay.
within the same financial year, which we for
Hmm.
which we are preparing consolidated financial statements. So there are two
Okay.
managements. So in
Okay.
that situation, what to do?
So if there's two management, let's say part of the year it was a subsidiary entity, so we'll report that till
Yes.
part of the year it was subsidiary entity. But the problem is,
Okay.
for part of the year we would not have their audit report, because audit report is issued at the year end only, right?
Yes. Yes.
So then
So
again
what
that
to
would be a
do?
challenge, because audit report is not there. So we can say that yes, for part of the year it was a subsidiary, but later half of the year it changed. So essentially the answer to this is again to be reported factually. Whatever facts are there, we need to report that, rather than just giving a conclusion on there's no adverse qualification, etc., of that sort,
Okay.
because
So
guidance note also in
can we
many
cover
places.
this in our next audit report or what?
Next audit report, I think it has to be at year end only. It could be cascading. I'll have to see that honestly, because
Okay.
this
Please.
is first time applicable for March 22, wherein we are not really going to other this thing. And if the year end is different, we state that. Perhaps if the year end, let's say, is December 22, and we are signing March 22, then we can
Yes.
definitely say that the audit report for December 22 did not have any qualification and reverse remarks, and that's a factual correct statement also to make. So that I think could be
Okay.
doable, unless and until there's some revision which comes up.
Okay. Thank you. Please continue.
Yeah. That's all from my side, sir.
Oh, it was really nice, and you just went at fantastic speed.
Thank you, sir.
It was almost non-stop talking, and
Yes, sir.
the depth of your deliberation is really unique. I have had the opportunity of listening to various speakers on the same topic, but the way you dealt with the subject, you took from the standpoint of the auditor also, then points to ponder. So this was really very nice deliberation, and we are really delighted to have you as a speaker because this is for the
Thank you,
first
sir.
time you
Thank
are
you. Thank
speaking in
you.
our study circle, and it was
Yes,
really
sir.
nice. So now the forum is open for questions. Nitish Chukji is also with us. He is a registered valuer, insolvency
Yes,
professional,
yes. You
and he
mentioned.
has been with Big Four also. So Nitish ji, now it is your turn to ask the questions.
You're putting me in a tight spot, actually.
No, 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 it's not like that. Nitish ji, you
इनफैक्ट
can
नितिश जी,
unmute
हमें तो
yourself.
आपसे पूछना चाहिए. आप बता रहे थे registered valuer. We were just waiting for to hear from you, but somehow we just could not.
Hmm. So Nitish ji, you can unmute yourself if it's possible, and then you can speak.
We can't
Is
hear
my voice
you.
audible?
Uh, yes,
Yeah,
yes,
now
now
it's
it is
better.
audible.
Yes.
Yes.
Yeah. So it was a very elaborate presentation made by Neha ji, and I am really thankful Gupta ji कि आपने invite किया आज इनको और even I had the privilege to listen to her. She had been very lucid and very elaborate on the changes in CARO as well as the Schedule 3. I like to supplement 2-3 points here, not a query from us, just to add to
Yes,
what she
please.
had spoken in the session. That reporting on the secured loan from banks and financial institutions on the basis of security of current assets. Under CARO, the limit is the sanction amount of 5 CR, but under the Schedule 3, there is no such limitation of 5 CR. So even if the sanction amount is less than 5 CR and uh, based upon the security of current asset, the company has taken the loan, and there are discrepancies in the stock statement or quarterly statement submitted to the bank, the management is under the obligation to report the same in the financial statements. तो अगर मैनेजमेंट को रिपोर्ट करना है तो आई एम आल्सो सिग्नेटरी टू दी फाइनेंशियल स्टेटमेंट्स, तो मुझे तब भी चेक करना ही पड़ेगा. बट कारो में रिपोर्टिंग इज रिक्वायर्ड ओनली व्हेन द सैंक्शन अमाउंट इज मोर देन 5 CR. Right? And second topic that
So
he
what you
has
mean to
touched
say
upon.
is, so Nitish ji, what you mean to say is, in case sanctioned limit is less and actual utilization is more, so what to do in such a situation?
So
Suppose it's a
टेम्परेरी
borderline case.
ओवरड्रॉन, हाँ टेम्परेरी ओवरड्रॉन है तो उसको इग्नोर कर देंगे. बट अगर सैंक्शन लिमिट आपका 6 मंथ्स के लिए आपको सैंक्शन हो जाती है या 3 मंथ्स के लिए भी सैंक्शन हो जाती है जिससे कि 5 CR का थ्रेशोल्ड ब्रीच हो जाता है, इन दैट केस ऑडिटर नीड टू रिपोर्ट इन द कारो.
ओके.
मैं अभी क्या कह रहा था कि इवन इफ द सैंक्शन लिमिट इज लेस देन 5 CR, लेट्स से 4 CR, and there are material differences between the stock statement submitted to the bank which do not tally with the financial statement, then also management is required to report और उसकी reconciliation भी देनी है. तो as an auditor when I am signatory to the balance sheet, तो मेरे लिए वो threshold जो है वो बहुत ज्यादा beneficial नहीं रहा, सिर्फ मेरी कारो रिपोर्टिंग के लिए वो 5 CR का threshold applicable हो. Right?
Yes, sir.
And second thing is, I'd like to touch upon the topic advances in the nature of loans. सबसे ज्यादा प्रॉब्लम इसी में ही होती है कि what is the advances in the nature of loans. For example, मेरी XYZ कंपनी है, उसमें मैंने एक ABC लिमिटेड को एडवांस दिया 2 CR का. This advance is against the supplies of materials, raw material or could be any other material. लेकिन मेरी पूरे साल की जो परचेज पर्टिकुलर पार्टी से है वो 10 लाख ही होती है, या फिर मेरी जो बजटेड परचेज है दैट इज वे बिलो द अमाउंट ऑफ लोन दैट हैज बीन अमाउंट ऑफ एडवांस दैट हैज बीन गिवन टू दैट पर्टिकुलर पार्टी. सो दैट अमाउंट विल क्वालिफाई टू बी द एडवांस इन द नेचर ऑफ लोन. राइट? तो यहाँ पे हमारा प्रोफेशनल सेप्टिज्म आ जाता है, एंड based upon case to case we have to report whether it is advance in the nature of loan or not. Right? एक थर्ड पॉइंट और आ जाता है कि गाइडेंस नोट में मेंशन्ड है बेनामी ट्रांजैक्शन से रिपोर्ट रिलेटेड कि मैनेजमेंट का क्या ओपिनियन है वो भी फाइनेंशियल स्टेटमेंट्स में डिस्क्लोज करना है अगेंस्ट दी केसेस दैट आर पेंडिंग. जहां पर बेनामी की प्रोसीडिंग्स चल रही हैं वहां पे मैनेजमेंट का क्या स्टैंड है, तो वो हमें लीगली उनके लीगल हेल्प सेल से रिटर्न में लेना होगा और उसको रिपोर्ट करना होगा फाइनेंशियल स्टेटमेंट में. रिक्वायरमेंट इज ऑफ द मैनेजमेंट, बट इट इज आवर ड्यूटी टू टेक द ओपिनियन फ्रॉम द लीगल सेल ऑफ द मैनेजमेंट. लास्ट बट नॉट द लीस्ट, द टेक फॉर द डे. In most of the clauses we have seen that there has to be a declaration given that the transactions are in compliance with FEMA Companies Act and not violative of PMLA. तो सर जिसको PMLA ही नहीं मालूम वो क्या डिक्लेरेशन देगा? तो टेक ऑफ द डे इज कोई भी बैलेंस शीट साइन करने से पहले PMLA को एक बारी पढ़ लें कि उसकी रिक्वायरमेंट क्या है, क्या रैशनल है, तभी डिक्लेरेशन को हम साइन कर सकते हैं. वैसे तो मैनेजमेंट ने रिपोर्टिंग करनी है, बट सिंस वी आर आल्सो सिग्नेटरीज टू द फाइनेंशियल स्टेटमेंट, वो इट इज ऑल इक्वल इन एप्लीकेबल टू अस आल्सो. तो PMLA पढ़ेंगे तभी उस डिक्लेरेशन को दे सकते हैं, अदरवाइज नहीं दे सकते. तो फीस जो है वो अकॉर्डिंगली आप चार्ज कर लीजिएगा इस बार.
तो नेहा जी, do you have any management representation letter for various types of clients which you can share with us? Not now, but at a later date.
हाँ सर, वो सब तो इंस्टीट्यूट अपना द सुप्रीम एक्चुअली वो इशू करते हैं, वही फॉर्मेट वी लेवरेज एक्चुअली।
ओके ओके ओके।
सो हम सब वही
तो
करते हैं जो
मेरे पास
इंस्टीट्यूट
एक
हमें
फॉर्मेट
बताता
है,
है इंटरेस्ट लेके।
हाँ जी सर।
एक फॉर्मेट है मेरे पास, मैंने बनाया था, तो आई विल
हाँ जी
शेयर
हाँ
विद
जी।
यू
ओके
दोनों
सर,
के
ओके
लिए,
ओके।
फॉर इंटरनल फाइनेंशियल
हाँ
कंट्रोल ऑल्सो एज वेल एज फॉर
हाँ जी हाँ
ऑडिट
जी,
ऑल्सो।
बिल्कुल बिल्कुल बिल्कुल, सो नाइस ऑफ यू सर। हाँ जी हाँ जी। तो भारद्वाज जी, वी कैन कंक्लूड नाउ। Bhardwaj ji, you are not audible. So, any other question from any other participants in the meantime? Manu Gavri ji is also there. ये गावरी जी के बेटे हैं अभी प्रिय जी?
यस सर, गावरी जी के बेटे हैं।
देखो अब नई जनरेशन भी आ गई है। है मनु
हेलो,
गावरी जी? हाँ जी हाँ जी। भाई आपके फादर तो हमारे दोस्त हैं, आपको देखा मैं क्या पूछ लूं।
अब आवाज आ रही है
आपकी
सर?
आवाज हाँ अब आ रही है। हाँ जी हाँ जी।
अब आ रही है गुप्ता जी मेरी आवाज? हाँ।
हाँ आ रही है जी, आ रही है। हाँ हाँ।
नीतीश जी से मैं पूछना चाह रहा था, एक इन केस ऑफ ए प्राइवेट लिमिटेड कंपनी देयर आर 3 ब्रांचेस। नीतीश जी सुन पा रहे हैं?
हाँ कोई नहीं,
मैडम
नेहा जी,
आपको
नेहा जी
एड्रेस
से पूछिए।
मैडम को
हाँ
एड्रेस कर रहा
प्लीज।
हूँ। इन केस ऑफ ए प्राइवेट लिमिटेड कंपनी देयर आर 3 ब्रांचेस।
हाँ जी सर, ब्रांचेस के बाद लॉस्ट योर वॉइस। सर आपका आवाज नहीं आ रहा है।
हाँ भारद्वाज जी, आपकी आवाज नहीं आ रही, या तो आप चैट बॉक्स में लिख दीजिए या फिर बाद में भी पूछ सकते हैं।
हाँ मैं सब यही हूँ।
हाँ, या तो
उन्होंने
आप चैट
3
बॉक्स में
करोड़
लिख दीजिए।
हाँ जी सर, आपका आवाज चला गया था। आई जस्ट हर्ड की कंपनी का 3 ब्रांचेस है, उसके बाद आपको बताना पड़ेगा।
हाँ
कंपनी की 3 ब्रांचेज हैं। उस कंपनी का एक डायरेक्टर 2 पार्टनरशिप फर्म के अंदर पार्टनर है।
हम्म,
आपस में उन्होंने कुछ ट्रांजैक्शंस कर रखी हैं। एक
तो
बीच
ट्रांजैक्शंस
बीच में
के
आपकी
बाद आवाज गया।
आपकी आवाज जा रही है बीच बीच में। लगता है कंप्यूटर 3 करोड़ के बाद साइलेंट कर देता है आपको।
कंप्यूटर कहते हैं बहुत छोटा अमाउंट बोल रहे हैं, थोड़ा बड़ा। ये 3 करोड़ से कुछ नहीं होगा, 10-20 करोड़ पे तो आओ।
आवाज नहीं आ रही भारद्वाज जी आपकी, यू आर नॉट ऑडिबल। या तो आप चैट बॉक्स में लिख दीजिए या फिर बाद में भी पूछ सकते हैं, नो इश्यूज। अनिल कपूर जी भी हमारे बीच में। अनिल कपूर जी नमस्कार। अरुण मलिक जी नमस्कार। राजीव महाजन जी
नमस्कार
भी
जी।
हैं। नमस्कार सर, आप भी पूछ लो कुछ।
नहीं सर, चलने दो, बड़ा अच्छा चल रहा है।
मैडम से पूछ लो, ये सब तो बता दिया करना है, पर इनसे बचना कैसे ये बताओ असली बात। क्योंकि मैनेजमेंट तो दूसरी चीज सुनना चाहती है ना। मैनेजमेंट कहती है भाई ये सब तो ठीक है, लिखा है शेड्यूल 3 में, लिखा है कारो में, लिखा है, पर आप हमें रास्ता भी तो बताओ ना क्या करना है। अब तो हमने तो कर दिया जो करना था। हमें तो अपना देखो स्टॉक के लिए सीसी लिमिट लेनी है, तो हमने तो अपना दे दिया जो भी स्टेटमेंट देना था। अब आप ये बताओ कि हमें बचना कैसे है। हाँ जी भारद्वाज जी, आपकी ना आवाज नहीं आ रही। कोई नहीं कोई नहीं। हाँ जी मैडम, तो इस पे भी कुछ प्रकाश डालिए ना, वो भी चीज जरूरी है। भाई
ठीक है
होता कि
सर,
देखिए,
उस दिन
स्टॉक
मिलेंगे।
स्टॉक में सबसे बड़ी प्रॉब्लम आने वाली है। स्टॉक में क्या होता है, अब वो कहते हैं जी देखो ऐसा है, हमने तो अपनी लिमिट तो कम करा नहीं सकते, तो अब लिमिट के हिसाब से जो है हमने तो अपना स्टेटमेंट बना करके दे दी। कई बार जीएसटी के इश्यूज आ जाते हैं, जीएसटी वाले बोल देते हैं जी ये फेक बिलिंग है, वो फेक बिलिंग का केस चल जाता है। इसका मतलब अगर उसके अगेंस्ट कोई फेक बिलिंग का केस चल रहा है, तो इसका मतलब वो स्टॉक तो एग्जिस्ट ही नहीं करता था ना, तो वो भी एक इशू आ जाता है कई बार। तो हाउ टू हैंडल सच प्रैक्टिकल इश्यूज?
उसका तो सर एक ही आंसर है, डू व्हाट इज राइट। डू व्हाट इज राइट इवन व्हेन नो वन इज वाचिंग। That's what I have learned growing actually.
हाँ जी, हाँ जी, हाँ, हाँ, हाँ,
तो एज एन ऑडिटर तो मैं यही एडवाइस दूंगी, डू व्हाट इज राइट व्हेन नो वन इज वाचिंग, देन यू आर अ ट्रू
हाँ,
ऑडिटर एज पर द कोड ऑफ एथिक्स बाय द
हाँ,
सुप्रीम
ये तो है।
ICI, ऑनरेबल
हाँ जी।
ICI.
वहाँ से देख लो भाई
So
की।
we are really thankful to CA नेहा मल्होत्रा जी for the wonderful deliberation,
Thank you
और
sir,
बहुत ही
thank you
मजा
sir.
आया और बहुत ही प्रैक्टिकल इनपुट्स दिए जिन पर अगर हम लोग काम करेंगे तो, एंड आई अश्योर यू कि नेहा जी विल बी काइंड इनफ टू आंसर योर क्वेरीज एट अ लेटर डेट ऑल्सो। देखिए ऐसा अभी बहुत सारे ऑडिट शुरू नहीं भी हुए हैं, तो आप, मैं नेहा जी के ब्याह पे आपको एश्योर कर सकता हूँ कि आप हमें व्हाट्सएप जो ग्रुप है हमारा, उस ग्रुप में लिखिए एंड वी विल फॉरवर्ड द क्वेरीज टू हर इन व्हाट्सएप और ईमेल, एंड आई थिंक शी विल डेफिनेटली आंसर एट हर ओन कन्वीनियंस। वो विद इन अ डे और टू आंसर आपको मिल जाएगा जो भी होगा। सो विद दिस वी आर एंडिंग द सेशन। भारद्वाज जी का कभी नेट आ रहा है कभी जा रहा है, कुछ इशू आ रहे हैं बीच में
3 करोड़
तो
पे अटके हुए ना, 10 करोड़ नहीं कर रहे.
हाँ जी, हाँ जी। सो इट वाज रियली नाइस एंड वी लुक फॉरवर्ड टू मोर सच सेशंस, and the presentation has already been shared with me and I'll be sharing it in the group in case
हाँ, मैंने
anyone is
आपके
not
साथ
included
रिवाइज
in the group. Yes, yes, yes,
रिवाइज
yes,
शेयर
yes,
किया है, वो आप शेयर कर लेना.
yes, yes, I've got it. I've got the revised presentation, and in case
ठीक है.
anyone is not included in the group, so he can send me a direct WhatsApp message. I'll forward the PPT to him or her. So thank you very much, it was really nice.
ठीक है.
Hanji,
थैंक यू सर,
thank you
थैंक
very
यू
much.
फॉर द
So we are
अपॉर्चुनिटी,
again
थैंक यू
delighted
सो
to
मच.
have you.
या,
Thank you ji, thank
थैंक
you
यू
all.
सर.
Hanji. So now we are ending the meeting with the permission of the speaker. Hanji. Thank you ji.